Hello everybody, this is Kieran from Cryptobulls, and today I want to talk to you about cryptocurrency fundamentals, a simple trading knowledge for new investors. You might have read about Bitcoin or Ethereum and would like to buy into it. So I thought I'd put together this video to show you some fundamentals, simple knowledge that will hopefully help you to improve your trading, investing, and so on. There are some key important aspects to investing in the cryptocurrency space, and they might be the same in other markets, but now we're going to focus on especially the cryptocurrency aspect of investing. So the table of contents, it's first of all we're going to look over what kind of base currencies there are, what a limit order is, market order, slippage, stop loss order, leveraged and margin trading, explaining what that is, spread, trading confirmation, what the trading confirmation means, various trend indicators like the moving average, convergence, divergence, MACD, Parabolic See, momentum indicators such as StochRSI, commodity channel index, relative strength index, Bollinger bands, some volume indicators like the Chaikin Oscillator, unbalanced volume, and volume exchange rate. So this video is not going to be a super in-depth video. I'm just going to go over the basics just so that you've got a bit of an idea. I suggest that you look into detail if you want to know more about the specific indicators. I will also show you how to find out more about that, and I will probably also cover that in future videos. So let's start. So base currency, this is actually quite easy. When you trade, you want to buy, you've got one currency or cryptocurrency that is stacked against, so like a trading pair. You can compare it like with Swiss francs and USD. So if you've got the base currency would be Swiss francs, that means all the other currencies are traded against Swiss francs. And the most common base currencies in the cryptocurrency space are Bitcoin and Ethereum. This is also why very often when Bitcoin price falls, that many of the other cryptocurrencies fall as well, since everything is following the Bitcoin price, since most of the other cryptocurrencies are traded against Bitcoin. Now there are also other base currencies. For example, on Binance you've also got the Tether, USDT, you've got BNB. So if you go onto Binance, we're on Binance here, you will have BNB, BTC, you've got different alts. I think they also added Ripple recently as a base currency. And yes, this USDT we already looked at. The important thing to know when trading is that you want to be trading into a base currency that you are familiar with and you trust, and you think that you know where the price will be going. And the more you trade, you get to like one currency more than another. Maybe your goal is to have more Bitcoin, so then you will be mostly trading with BTC as a base currency to trade against Bitcoin. So for example, you want to accumulate more and more Bitcoin, you might be always trading back and forth. When Ethereum has a higher exchange rate to Bitcoin, then you might be selling Ethereum, so you get more Bitcoin, and the other way around. Now a limit order, when you're trading, most platforms have got the same names for the order types, and I think this is one of the most important aspects, even if you want to do any day trading and so on. Also just for long-term investing, you at some point have to make an order to buy certain coins that you can't directly buy on exchanges. So let's head over again to Binance, and here you've got the level 2, and you've got the current price, and down here you've got a few options to make some buys. So on the left side you've got limit, and you can buy BTC. Now to explain what a limit order is, if for example you want to buy Bitcoin, you're gonna say which price you feel that is fair to you to buy Bitcoin. So you might say $5,505 is your fair price. So you'll set that in and set it. And the good thing about a limit order is that you will always sell to the price that you specify, to the exchange rate that you're specifying down here. So you want to sell a certain amount of Bitcoin for the price that you set. So if I click here, you would have $5,506. Now the thing is, you will have to wait. If the market is going in your favor, then probably it will the price will go down towards the asking price that you have, and it will be fulfilled. The thing with limit orders is that it probably takes some time. It could take a few seconds, minutes, or even hours, depending on the liquidity of the market. But the good thing is you definitely know which price you're going to have. So limit orders in comparison to market orders, which we will look at afterwards, you will have a certain price, and you will know that you will have that price. Doesn't matter how many Bitcoins you're selling, or another cryptocurrency for that matter. Now market order is a lot different. If you're not in a hurry to sell, I don't suggest that you use market order. Market order can be found here. So basically market order, you will be selling not only for the price that is here, but your order will be fulfilled at the complete market price. It's a bit more complicated to understand, but I'll try and do my best. Now here we see we've got amount of Bitcoin that have been bought. If you want to sell a lot of Bitcoin and you process a market order, then you will be selling for all the prices that go below the current price until your order is fulfilled. That means that you will be selling at maybe $5,504, $5,503, and so on. So you will have maybe a few of your sales will be executed at one price, and the rest will be executed at a much lower price. This is very important because if you perform a market order, you will not know which price you're going to be selling at, and the difference can be very high if the asking prices have a large spread we will look at afterwards, but keep that in mind. So if they have a large spread, then the price will fall quite a lot until your order is fulfilled, and you might have a big difference between the lowest price that you sold for and the highest price that you sold for. So you might, if you're selling a large amount of cryptocurrency, that can make a big difference, a few percentage. So unless the market is really going in a direction that you don't want, I don't suggest that you use market order. And the same goes for when you're buying. The market and limit orders, they go both ways for buying and selling, just it's the other way around. Yeah. So slippage, this is very important because we looked at that. It's mostly slippage has a lot of effect when you use market order or some type of stop loss. However, stop loss is not on Binance. You've got something that's called stop limit, but that's similar to a limit order. However, slippage is the difference between the price that you want to sell at and the price that you're actually selling at. So this difference is the slippage, and that is mostly dependent on the liquidity of the market and how many buyers or sellers are currently on the market, and the difference in price that they're asking. So if there are not many buyers, then it's possible that there is a large discrepancy between the buying price. For example, you might have here $100 in difference, and that means that when you sell a large amount of cryptocurrency, then you have a huge loss due to this slippage. And this is, if we go back to market order, that's why I mentioned that it's not the best option when just doing some normal purchases, because you can not really control what price you're buying or selling for because of this slippage that's happening. So if you're buying new cryptocurrencies on Binance or other exchanges, then definitely just use the limit order, since you know what you're going to be, which price you're going to be selling or buying. Here I explained it a bit more in detail. If you want to go down, I put a link down to my site to this post. Stop loss order. Now, like I mentioned before, on Binance you won't have a stop loss order, since this is mostly for leverage trading, when you trade at a multiple of your invested capital. Basically, a stop loss is when you decide that you don't want to keep a position, then you will sell at that when the market reaches a certain price. Like the market goes down and it reaches a certain price. I'll show you maybe here on for example, you enter the market here on BTC USD at $5,403, and you think this is a good position, it will go up. It's possible that you put maybe you put a stop loss order at 5,338 as an example. Now if the market goes down and reaches here, it will perform a stop loss market sell, and you will suffer some losses due to slippage and so on. Yeah, that's about it. Now, leveraged margin trading, highly risky, can also be very profitable. I don't suggest that if you are new to trading or new to cryptocurrency, I would first learn a lot about the different markets and just do normal trades before you venture out to leverage trading, since high leveraged accounts on, for example, BitMEX easily get liquidated, especially with like 50x or 100x margin trading. So first of all, to explain what it is, you put a certain amount of either US dollar or cryptocurrency on your account, either on Bitfinex or on BitMEX, and with this amount of money you're allowed to trade with a higher amount of currency. So typically for Bitfinex you will have a 6 times leverage. So for example, if you put around $1,000 US in cryptocurrency, then you will be able to trade for around 5,000 to 6,000 US. You can perform leveraged buy and leveraged sell orders. You don't have to hold the currency that you'll be selling. So you can have, for example, Bitcoin on your wallet, on your margin wallet, and then you can still buy or sell Ripple at with your leverage account. It's very profitable, especially when the market is going down. During the bear market, leverage trading is extremely possible, since it's not that easy to make a lot of money during a bear market, apart from selling your cryptocurrency at a high and then buying it back in. It's still quite difficult to just make a profit, and for that reason it's a good tool, especially during a bear market, if you understand the different aspects of trading and different indicators, to hopefully either reduce some losses that you have, or just have some fun. And yeah. Alright, The spread, we looked at spread already. Trade confirmation, this is basically quite easy. When you're set a limit order or margin order and your trade is executed, then that means that you've had a trade confirmation. Yeah, that's about it. Some trend indicators. Now, trend indicators are important part for trading cryptocurrency in general. You will have this also in other trading forms, for example stocks and ETFs. You can use similar indicators. One of the most popular ones is the moving average, and you will see that very often you will see people talking about golden cross or death cross and so on, and those occur when two moving averages cross, the 50 and the 200 candle moving average. And this is quite interesting and a very easy indicator to use. If you head over to TradingView, you can create a free account and you can experiment with the different indicators. You can find some that talk to you, that you like a lot. So if we here over on TradingView on your account, you can click on indicators and you can type in moving average. You've got the moving average exponential and the normal moving average. The moving average exponential, actually, the last candles are higher weighted than the older candles. So if the price goes up, the recent curve is much more like it goes more in that direction. But let's first look at the moving average. We'll set two moving averages here. We can change it and select, for example, we'll make a 20 candle moving average and we'll have a 50 candle moving average. Alright, so the orange yellow line, I'm not sure what color that is, and the blue line is the longer moving average. So we'll take these 50, for example, we'll take this point here on the, let's take a higher time frame, 1 day, sounds good. We've got here the 2nd of May. If we look at the blue candle, this point here represents the last 50 candles and an average between the closing and opening prices. And as you can see, this one is much lower and less responsive than the orange line. This one is an average of the last 20 candles. Now, what you can see here is these are crossing at certain points, and what you can actually do as a basic basic trading trading rule, you can think about buying each time when the two lines cross, and then selling when they cross again. So when the orange line crosses over, that means that the current price is higher than the average price of the last 50 days, for example. And if you take it on a very long time frame, this helps you also see if we're in a bull or bear market. So this is a very easy example to visualize what I mean with that. So here we have starting off even actually somewhere around 2016. The last bull run started quite early, and most people actually just started realizing about it around $3,000 to $5,000. But as you can see here, the whole way all along 2017, the orange line is above the blue line, which indicates which indicates it's a good signal for a bull trend. I wouldn't use this as the only signal, but it's an easy one to implement and gives you a rough overview of the situation. Now, if you would just use that strategy to buy when it crosses, you would have bought somewhere down, maybe somewhere around down here, and you would have sold when Bitcoin crossed at around $6,000 or $7,000, and you would have made a hefty profit. Now, as you might notice, you won't be selling at the highest, and you probably also won't be buying at the lowest, because if here it crosses again, Bitcoin will probably also be around 7,000 or 8,000. Yeah, so you won't be buying at the lows, and you also won't be selling at the highs. That's why I suggest that you use different indicators. Let's continue. Convergence, divergence, MACD, and this is actually simply the difference between two exponential moving averages of different periods, and this is a 12 and 26 day periods and commonly used for this. So you will see them crossing over. The bars here represent the difference to the average, and it will help you see where there might be a reversal, either a bull market becoming a bear market or the other way around. Parabolic See is also very interesting. You can use this, it will calculate some points, and you can use this for stop losses and see some trend reversals. You can use this and put your stop losses or your manual stop losses if you're not doing leverage trading, and decide where you want to exit the market or enter the market again if you feel like the trend is going another direction. So for example, here you feel like the trend is going down, you might be able to, on this one here, on this dot here, you make a line and you set your stop loss or your manual sell there or buy back here, for example, and so if the market goes back up again, you would buy back and just lose out on a few percent on profit, but you still catch the next upswing. So it's a very useful and visual indicator to help you see trend reversals. Now the Stochastic Oscillator RSI, I enjoy this indicator a lot, and I probably talk about it more in the future. It's an indicator of how much stock or cryptocurrency has been bought or sold, and it helps you see if the stock has been overbought or oversold. And you can read a lot in this type of indicator. That's why I like it a lot. And there's also quite a few hidden aspects to this indicator that people might not be aware of it, especially new traders. So let's install this indicator on our TradingView site. Let's see, RSI, Relative Strength Index. Alright, we've got it here. As you can see, the highs are around 90 and the lows are around 27, 29, for example. Here we've got that. When the price goes up, you will notice that the RSI also goes up and signals that the currency or stock has been bought at a high price, and also the interest is going down. Now for a new investor, it's definitely not a good idea to start buying anything if the RSI is very high. Now we've got the daily here. For a new investor, what I suggest is using the RSI in combination with dollar cost averaging if you're interested in buying over a longer period of time, instead of just using the dollar cost average. That means every day, for example, $10. that you actually look at the RSI and always buy when the RSI is below, so let's say 40 or 30, and that will always show that you have bought at the time when the stock has been really oversold and not overbought. So let's look at some peaks. We've got one peak here where Bitcoin is at $9,700 on the 4th of May 2018, and you can see that the RSI is also relatively high, so I wouldn't suggest buying at this date. Of course, looking back at the time, it's always easy to say when I would buy or when I wouldn't buy, but with the RSI I've always been able to hit some very good lows and just make sure that I'm not buying at the peaks. Now if the price continues to go down, you still experience some losses, but however you might hope that using the dollar cost average method and another strategy, you might be able to increase your chances for profit. So now here the last purchase I made, it was around but I didn't buy Bitcoin though. I bought some other coins. I just didn't buy Bitcoin, and I bought around when RSI everything actually sunk down to the low levels, and I bought some. So this is a very good indicator. One thing to notice is that you can have some hidden so for example, you have a divergence where the peaks on the RSI do not represent the peaks on the chart. So for example, here you might have at some point, let's see a good example here. We don't really have a good example. We might have to open the chart up a bit to find a better example of a hidden divergence. So for example, this is not actually a hidden divergence, since yeah, this is not a good example. Well, never mind, and we might look at that on another other day. Alright, let's just continue, otherwise this video is going to be way too long. I think I've already overdone it a bit, but never mind. Now let's look at Bollinger Bands. I made a really interesting post here on how to trade the Bollinger Bands, and I think we'll look at this first before we go to our charts. Now we can have here, we can install the Bollinger Bands here, and let's see. So Bollinger Bands are very interesting, since it's also a very visual tool that you can use to hopefully figure out when the price will explode in one direction or the other. It might go up or down, and with the help of the Bollinger Bands, hopefully you can anticipate these moves a lot better. So there are 5 main signals in the Bollinger Band strategy, and it's based on approaching price action. So you've got Constriction, Bullish Expansion, Bearish Expansion, Bullish Move Up, and Bearish Move Down. So approaching price action based on both bands, you always look at both bands to get clues of what is going to happen. Now Constriction, the bands constrict when there's decrease in volatility. Unless the average daily range decreases, they will not constrict anymore. It is then important to look at what the bands will do in order to decide if you want to enter position or exit long or short if you're doing leverage trading. So as soon as the bands constrict, especially in a long time frame, you have to expect a big move in one or the other direction. Then it's also important to look at some other indicators like support or resistance levels. Bullish expansion, price is going to walk along the upper band, and that is critical for bullish expansion, is that the lower band is expanding in the opposite direction out of the constriction phase. When the price follows the upper band, heads up and the lower band goes down. This is an ideal entry for a long position. As you can see here, the lower band is going down, and as soon as it curves another direction, you will know that this expansion has started to stop. So as long as the lower band is going in the opposite direction, then you know that the price will continue to go up. And of course the same goes if it's going the other way, same case. Now bearish expansion. This is just the opposite, like I just said before, with the price walking down the lower band, and it's also important to look at the upper band since it will go up in the other direction. Bullish move up. Here we have a bullish move up, and this is a good example why it's critical to look at both bands. When the upper and lower band move up together, this is still a bullish move up. However, the expansion is not as predictable as we would like. Even though the move up might still take place, it's not as strong as a signal as the bullish expansion. Also doesn't happen in an exponential manner. Bearish move down. So we've had quite a few of these in the last few months, especially in 2018. This is similar to the bullish move down. Since both bands are going down, there won't be any strong price movement until there's an expansion or constriction of the bands. So yeah, that was it for Bollinger bands. This is a very interesting topic, and I like this indicator a lot. And we have a few more, like the Chaikin Oscillator for measuring momentum and on balance volume. We will look at this in another time, or you can read about it in the post below, since I have to cut this video short. It's becoming very long and I've been rambling on for quite a bit. The last one I want to talk about is volume exchange rate. Even though this indicator is not as important on its own, it's still a very important indicator, since even though it doesn't guarantee a price increase in the future, you can consult it with another indicator and use it as a confirmation. In this case, a high trading volume would strengthen the buy signal, while a lower trading volume could question the buy signal. And also, if the price is on a support level, then a low volume might signal that the price might drop below that support level, since you need a good volume to go to the next resistance. Now is the last point for shorting Bitcoin, how you can benefit from falling prices. While investors are expecting the stock to gain value with going long and buying, traders are going to anticipate that the stock will fall, and Bitcoin short selling is a big thing, especially in the cryptocurrency space. Many people talk about shorting and leverage trading. However, even though it is a possibility, I highly suggest that as a new trader that you just keep your fingers away from it, especially at the beginning, because it's high risk. Cryptocurrency is high risk anyway, and I don't suggest as a new trader that you go into this. However, if you like risk and you don't mind losing everything, since especially with 50x or 100x, you get wrecked and liquidated in no time. There are two major leveraged trading sites. The first one, even though I was a big fan of it, I would be quite a bit hesitant, especially now due to the USD tether news, and that is Bitfinex. I don't suggest using it at the moment, since it's not certain how the liquidity is of the site, so I would just wait on that one. And BitMEX, I haven't really used BitMEX that much, and at the moment I just prefer looking at long-term investing and less leverage trading. So I hope that you enjoyed this video and you learned something from these fundamental elements of cryptocurrency trading for new investors. Yeah, I'll catch you on the next one. Have a nice evening.